Hello everyone, I am Remy Jonkam Oben, a PhD candidate in the Department of Business Administration at Near East University. I present to you our research which we conducted on the interconnectedness and optimal portfolio allocation strategies involving decentralized finance instruments, green investments, and fossil fuel energy commodities before, during, and after the COVID-19 pandemic. As we all know, nowadays there is a global shift toward sustainable investments and net zero carbon dioxide emissions. Also, leveraging blockchain technology, the concept of decentralized finance has emerged as an alternative to traditional finance, replicating financial services without the need for traditional financial intermediaries. Moreover, the COVID-19 pandemic introduced uncertainty into global financial markets and amplified volatility transmissions. Therefore, it is essential to ascertain the volatility connectedness and optimal portfolio allocation strategies involving these distinct asset classes. In this study, we explore the volatility spillovers and optimal portfolio allocation strategies involving these asset classes. In the existing literature, several research gaps remain. First and foremost, there is limited understanding of the interconnectedness among these asset classes. Also, the impact of the COVID-19 pandemic on emerging asset classes has not been sufficiently analyzed. Moreover, with respect to optimal portfolio allocation strategies which involve the emerging decentralized finance asset class, the evidence provided in the literature so far remains inconclusive. Therefore, this is the first study to comprehensively examine the volatility connectedness among these instruments, especially by integrating the impact of the COVID-19 pandemic. Moreover, this study provides methodological rigor by employing both the VAR-based Diebold and Yilmaz 2012 framework and the dynamic conditional correlations models. The theoretical underpinnings of this study include the modern portfolio theory, which was put forth by Professor Harry Markowitz in his famous 1952 paper. Also, to ascertain the volatility connectedness among the instruments, we leverage the volatility spillover theory. To understand how investors react amidst the pandemic, we leverage behavioral finance and crisis theory. In terms of our data and methodology, for the data, we employ daily price data from March 15, 2018 to August 30, 2024. Therefore, we have 1,550 observations. For our variables, we have 3 asset classes. For the decentralized finance tokens, we have Chainlink, Maker, Basic Attention Token, and Synthetic. For the fossil fuels, we have the futures prices of oil, that is crude oil, natural gas, and coal. And for the sustainable markets, we have market indices for Global Clean Energy, Kensho Clean Energy, and Kensho Clean Technology. Methodologically, we employ the Diebold and Yilmaz 2012 framework to estimate the volatility connectedness and the dynamic conditional correlations multivariate generalized autoregressive conditional heteroscedasticity model for optimal portfolio allocations. Our key results are divided into 2 parts. Part A is for the volatility connectedness and Part B is for the portfolio optimization. With the first part, volatility connectedness, we look at both the static, that is the time invariant, and the dynamic, that is the time varying results. For the static or time invariant or average results, we found that there is low volatility connectedness overall among these 3 different asset classes, with the total volatility spillover index being just 33.7%. Now, the sustainable markets were the highest contributors to overall volatility spillovers, and overall they were net volatility transmitters. The fossil fuel commodities were the lowest contributors to overall volatility spillovers, and they were net receivers of volatility. Within the DeFi, that is the decentralized finance ecosystem, we found moderate interconnections between the instruments. However, we found very low interconnectedness between across different classes. Now, for the dynamic results or the time varying results, we noticed that volatility spillovers increased when the COVID-19 pandemic came out, due to the outbreak of the COVID-19 pandemic, as we can see in the next slide. Here we notice a sharp increase in overall volatility connectedness towards the end of 2019 and around the beginning of 2020. We can attribute this to the outbreak of the COVID-19 pandemic. And around November 2020, when vaccines were introduced, we noticed that the overall volatility connectedness declined. Again, from 2021 to 2022, we noticed that the overall volatility connectedness gradually increased. This is because new variants of the COVID-19 pandemic emerged. In terms of directional spillovers, this slide shows us the directional volatility spillovers from one instrument to all other instruments. And this other slide shows us the directional spillovers from all other instruments to a given instrument. And the key insight we can get from both slides is that overall and on average, the decentralized finance instruments transmitted to and received from all other instruments the highest volatility throughout the study period. So compared to the other asset classes, the decentralized finance instruments were the highest transmitters and receivers of volatility on average throughout the study period. In terms of net spillovers, we notice that the statuses of the different instruments kept alternating between net volatility receivers and net transmitters throughout the study period. Now, to validate the robustness of our dynamic spillover results, we employed a moving window analysis where we varied the sizes of the rolling windows from 200 to 300 to 400. And we notice in this slide that all the graphs are consistent, which means our dynamic spillover results are robust because they are not sensitive to a particular rolling window size. Now, in terms of portfolio optimization, we employ the dynamic conditional correlations model. Using this model, we obtain the conditional variances, conditional correlations, and conditional covariances, and leveraging the modern portfolio theory of Professor Harry Markowitz, we computed optimal portfolio weights. And we found that in DeFi portfolios, higher portfolio weights were allocated to basic attention token and maker, while the least weights were allocated to Chainlink and synthetic. In the green portfolios, higher allocations were done to Clean Energy Index and Kensho Clean Energy Index and Global Clean Energy Index, while the least weight was allocated to Kensho Clean Tech Index. In the fossil fuel portfolios, higher allocations were made to crude oil and coal, while the least allocation was made to natural gas. In cross-asset portfolios, now, in portfolios which involve DeFi asset and sustainable investment, we notice that higher weights were allocated to the sustainable markets, and this is due to the global shift towards sustainable investments. In DeFi fossil portfolios, higher allocations were done to the fossil fuels, and in green fossil portfolios, higher allocations to the sustainable markets. Our results validated all our research hypotheses, and we also saw that the COVID-19 pandemic had significant impact on both volatility connectedness and optimal portfolio allocation strategies. So, in terms of recommendations, we recommend that investors should diversify their portfolios by including sustainable investments, particularly clean energy index and as well as oil, coal, basic attention token, and maker. Oil and coal are portfolio stabilizers. and they should allocate higher weights to the sustainable markets. Moreover, for policymakers, they should develop robust regulatory frameworks for the DeFi ecosystem, and they should promote green investments. They should facilitate the transition from fossil fuels to clean energy, and they should also enhance investor education on sustainable investments. So this is a summary of our results showing all the of our study showing all the results which I just explained. Thank you.